tested a 5-minute scalping system on 100 trades, and what I found was more interesting than I expected. The system was able to catch some of the best market entry points, but it also caused losses in a few situations. Today, I will share with you part of this test and all the real results of this test, without hiding the wins, losses, and mistakes. A good trading system is only worth it if it can survive in different market conditions. When the price is trending, when the market is suffering, and even when deceptive moves occur. That is why I decided to conduct this experiment. A 5-minute scalping model is built on a combination of several important concepts: short-term price movement, liquidity behavior, and points that larger market traders pay attention to. What really happens if you enter a trade 100 times with a specific strategy? How many times does the market move as you expect? How many times does it get you out of the trade before the main move? We will examine the answers to these questions in the rest of the video. Add these indicators. First, EMA9 and EMA21. Momentum shows the strength of the market movement in that everyone knows. And second, VWAP uses it to detect the volume-weighted average price. Based on volume, here we have a position on the chart that has all the conditions for our system. The first thing I look at is the general direction of the market. At this point, the price is above the VWAP, indicating that the buyers are currently in control of the market. Then I look at the EMAs. Here we see that the EMA9 is above the EMA21, and the gap between these two averages indicates that the short-term momentum is upward. But we are not entering the trade just because of the EMA cross. This is where the important part of the SMC comes in. Price has gathered a liquidity area before the main move, and after the short-term structure is broken, it gives us a signal of a continuation of the upward movement. So our three main factors are in the same direction: the direction of the price relative to the VWAP, the momentum of the EMAs, and the confirmation of the market structure. Therefore, this is where our entry point is formed. We place the stop loss behind the last zone, which, if the price reaches, means that our analysis is no longer valid, and we determine the target based on the risk-reward ratio. In this trade, the price moves exactly according to our scenario after entry and reaches the target. But the important thing is that we are not examining a trade. A strategy is valuable when it can perform well over and over again in different market conditions. Now let's move on to a counterexample, a trade that looked good but ended up failing. Because in a real backtest, we don't show only wins. Now let's examine a losing trade, because it is precisely these parts that teach us the most lessons. Here we have a situation that looks very attractive at first glance. The price is close to VWAP, the 9 EMA, and 21 EMA are also showing signs of an uptrend, and there is even a small breakdown in the market structure. If we had entered only after seeing one or two signals, we would probably have opened a long trade here. But where was the problem? The problem was that all the factors were not yet fully aligned. The market was still in a sensitive area, and liquidity had not yet accumulated above the previous high. This meant that the price could have made a deceptive move first and then chosen its main direction. And that is exactly what happened. After the entry, the price initially rose slightly, but could not maintain the move, and with a quick reversal, the stop loss was triggered. This trade illustrates an important point. A good strategy does not mean that every trade will be a winner. Even the best systems lose money. The difference between a professional trader and a trader is that they know that losses are part of the game and don't let one bad trade affect the entire account. Now that we've reviewed a few trades, it's time to get to the big stats. Of the 100 trades tested, I recorded each trade, the number of wins, the number of losses, the average risk to reward, and under what conditions the system performed best. So let's move on to the next trade. Here we have a different situation. The price initially trades below the VWAP, which indicates that there is more selling pressure in the market. But what catches our attention is that the price has made a downward move and then started to gather liquidity at the bottom. We are not waiting for a rush here. Many scalpers make a mistake here and enter the trade just because of a quick move. But we are waiting for the market to give a clearer signal. Here, after gathering liquidity, the price has turned back up again and created a short-term structural breakdown. Now, the EMAs are also starting to change their behavior, with the EMA9 above the EMA21. But since the price is still near an important area, we are not going to make a direct entry. We are waiting for a pullback. After the price returns to the desired area, all conditions are aligned again. The market structure has changed, momentum has returned, and the price is in a favorable position relative to VWAP. This is our entry point. The stop loss is placed behind the last low, and the target is determined according to the same initial rules. After the entry, the price makes the expected move, and the trade is closed with a profit. But the important thing about this trade is not only its result. What is important here is waiting for confirmations. If we had entered 30 seconds earlier, we would probably have caught a fake move. Well, let's move on to the third trade. This is one of the most interesting examples of this backtest, because it shows exactly why just seeing a few signals is not enough. Here, at first glance, everything looks ready for a buy trade. The price has started to reverse, the 9 EMA is moving up, and its distance from the 21 EMA is changing, and the price is also near a range that could cause the bullish move to continue. But there is one important point. Before we enter, we need to see where the market is. The price is still below a significant liquidity area, and the buyers have not yet managed to take full control of the market. So instead of just seeing the initial move, we wait. A few candles later, the market makes a quick move up, and many traders think that this is the start of the main move. But this is where many get caught. This move is actually a fake breakout. The price collects liquidity above the short-term high, but cannot consolidate higher. After that, selling pressure enters the market, and the price quickly reverses. If we had entered on the first move, we would probably have faced an unnecessary loss. But according to the rules of this system, since there is no full confirmation, we reject this trade. And this was one of the most important results of this backtest. Sometimes the best trade is the one you don't take. During the 100 trades, there were a lot of positions that were attractive on the surface, but eliminating them improved the quality of the results. Finally, this backtest taught me one important thing. No strategy is going to win all the time. The real advantage comes when you have a solid system, follow its rules, and don't let emotions control your decisions. Combining tools can give you better insight, but what makes the difference in the long run is discipline, risk management, and proper execution. I only kept 6 out of 100 backtests to see which ones really work. If you like these kinds of real backtests and scalping strategy analysis, subscribe to the channel so we can do more tests and reviews of different trading systems together. And if you have a strategy you'd like us to backtest, write it in the comments.